Are diamonds the next big investment opportunity? Discover how diamonds are set to become a commoditized asset class with huge potential gains, while economist Steve Hanke warns of looming economic downturns due to the Fed's policies. You'll get in depth analysis on how to safeguard your investments amid potential rate cuts and market volatility. Don't miss these crucial insights that could redefine your financial strategy. Today on Financial News in Review, we will summarize the following videos. From Kitco News, we have Are Diamonds Set to Become an Investable Commoditized Asset Class That Outperforms? Cormac Kinney. From David Lynn, we have When Will the Fed Cut Rates? Will Economy Crash Before Pivot? Economist Steve Hanke answers. In this interview, Kitco News hosts Cormac Kinney, who discusses the potential of diamonds becoming an investable commoditized asset class, providing in-depth insights and analysis. The core thesis of the interview is that diamonds, despite their recent price downturn, are poised to become a significant investment commodity. Cormac Kinney argues that the financialization of diamonds will drive substantial demand and increase their value, supported by thoughtful commentary and evidence from industry trends and technological advancements. Key points discussed by Kinney include 1. Current market dynamics. Kinney elaborates on the reasons behind the significant decline in natural diamond sales. He cites the invasion of Ukraine by Russia, which led to Russia dumping diamonds to raise cash, and the rise of lab-grown diamonds as factors impacting the market. However, Kinney believes that the demand for natural diamonds is rebounding as both retailers and consumers shift back from lab-grown alternatives. 2. Transformation into commodities. Kinney explains how Diamond Standard has created fungible diamond commodities through technology and computer science. By optimizing the combination of diamond characteristics, carat weight, color, clarity, they have developed equivalent diamond bars and coins that can be traded as commodities. This breakthrough allows for price transparency and market value equivalence on a given day. 3. Standardization process. Kinney discusses the technical and statistical methods used to ensure all diamonds in a bar or coin are essentially equivalent, thus standardizing them into a tradable commodity. Using a combination of market making and sophisticated optimization algorithms, Diamond Standard buys a statistically valid sample of diamonds and forms standardized bars or coins. 4. Economic and ethical considerations. Kinney emphasizes the economic benefits and job creation associated with natural diamond mining as opposed to lab-grown diamonds. He also dispels myths about the prevalence of blood diamonds, noting that all diamonds entering the U.S. market come with UN-certified Kimberley certificates to ensure ethical sourcing. Number 5. Regulatory and security measures. The interview highlights Diamond Standard's adherence to regulatory requirements under the Bermuda Monetary Authority and its collaboration with Brinks for custody and security of the diamonds. This ensures investor confidence in the ownership and delivery of their diamond commodities. Additionally, Kinney makes several key predictions. 1. Growth in investment demand. Kinney predicts that as diamonds become financialized through ETFs, futures, and options, investment demand will drive diamond prices up significantly. He draws parallels to the price surges seen in other precious metals upon the introduction of investment products. 2. New markets. He foresees new demand from digital assets and sharia-compliant financial products. There's an expectation that the integration of diamonds into sharia-compliant finance will further boost demand. In conclusion, Kinney summarizes his insights by encouraging viewers to consider investing in diamonds now, while prices are low and before the broader market, including institutional investors, begins to participate heavily. He emphasizes the unique opportunity for early individual investors to benefit from the anticipated rise in diamond values. Key takeaway: diamonds are at a historic low price, making this an opportune time for individual investors to enter the market before major institutional investments drive prices up. The title of the video: When Will the Fed Cut Rates? Will Economy Crash Before Pivot? Economist Steve Hanke answers, hosted by David Lynn. Professor Steve Hanke, professor of applied economics at Johns Hopkins University, globally renowned economist, expert in monetary policy and currency reform. Main topic: Federal Reserve's rate decisions, economic outlook, and monetary policy analysis. Core thesis of the interview. The interview revolves around the implications of the Federal Reserve's monetary policy decisions on the economy, particularly focusing on rate cuts and potential economic downturns. Key arguments by Professor Hanke. Muss 1. The role of money supply in economic trends. Discussion. Hanke explains the importance of money supply, criticizing the Fed's stance that changes in money supply have minimal impact on inflation and economic activity. Example. He elaborates how the contraction in money supply since March 2022 signifies a slowdown in the economy, projecting future economic challenges. 2. Disinflation versus deflation. Discussion. Hanke's forecast is for continued disinflation, with the headline CPI potentially dropping to 2 to 3% by the end of the year and possibly below 2% by 2025. Example. He uses current price cuts by major retailers like Amazon and Walmart to illustrate the disinflationary trend, while cautioning against confusing relative price changes with overall inflation metrics. 3. Future of Fed's monetary policy. Discussion. Hanke believes that the Fed is unlikely to cut rates immediately, contrasting with recent actions by other central banks like the Bank of Canada and the ECB. Example. He emphasizes the importance of monitoring the money supply growth rate relative to the Fed's 2% inflation target and argues against raising interest rates further. Key points discussed. First key point. Hanke on labor market data. Despite recent job growth numbers, he sees an overall weakening trend in the labor market, which aligns with his expectations of an economic slowdown. Evidence. He references recent unemployment statistics and non-farm payroll data to support his assertion. Second key point. Money supply and nominal GDP. Highlighting the strong connection between money supply and economic performance, Hanke criticizes the Fed for ignoring money supply metrics. Evidence. He describes how contractions in money supply have historically led to recessions, drawing parallels to rare events since the Fed's inception in 1913. Third key point. Effects of quantitative tightening. Hanke urges the Fed to stop quantitative tightening, warning of its detrimental impact on economic stability. Evidence. He underscores the consequences of historical money supply contractions, linking them to significant recessions and deflationary periods. Additional key points. Geopolitical risks and safe haven dynamics. Hanke discusses the resilience of the U.S. dollar amidst global tensions, attributing its strength to its status as a safe haven currency. Debt concerns. Highlighting the anticipated higher costs of rolling over maturing U.S. debt, he projects increased financial strain on taxpayers. Predictions by Professor Hanke. Prediction 1. Inflation trends. Hanke predicts the headline CPI will range between 2.5% and 3% by the end of the year, but could potentially drop below 2% by 2025. Implications. Suggests persistent disinflationary pressures are likely to continue, influencing future Fed policy decisions. Prediction 2. Recession likelihood. With the ongoing contraction in money supply, Hanke believes a recession is inevitable. Implications. He sees parallels to previous historical recessions brought on by similar money supply contractions. Conclusion. Professor Hanke concludes by reiterating the critical need to monitor money supply as a determinant of economic health and inflation. He emphasizes that viewers should remain cautious about potential economic slowdowns and the importance of understanding monetary policy mechanisms. Final takeaway. Hanke highlights the importance of realistic and careful economic predictions, urging viewers to stay informed and engaged with economic policies affecting their lives. In these compelling discussions, experts Cormac, Kinney, and Steve Hanke present contrasting views on potential opportunities and risks. While Kinney highlights the untapped potential of diamonds becoming a major investment asset class, Hanke warns of economic downturns if the Fed continues its current monetary policies. Despite their different focuses, both agree on the importance of strategic timing, whether it's leveraging the low price of diamonds or keeping an eye on monetary supply metrics to avoid recession. Stay informed with these crucial insights for more informed financial planning. Thanks for watching Financial News in Review for Wednesday, June 12th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see, drop a comment below. See you next time.